Hello, Money Magnets. Welcome back to our Money Magnet podcast, where we discuss topics that help you take control of your finances with all the confidence that you need. In today's topic, we are talking about investing and more specifically, the seven biggest and most common investing mistakes. Mistakes that will quietly erode away your wealth and can cost you literally millions.
ETFs or exchange traded funds. You probably have heard of them of being a fantastic tool to save for your financial future. And maybe you even have a savings plan that is running. Well done if you do. But here's the thing, if you have a DIY portfolio, that is, of course, a solid start, but it isn't necessarily the golden ticket to a comfortable retirement. Too many of us are losing out on serious returns because of avoidable mistakes.
This is so true, Anna. Studies have shown that private investors can lose, I think, up to 4% on annual return due to common mistakes, such as overconfidence, poor diversification, or a very dangerous one, having an emotional buying behavior. And if you add that up over like 30 years, that can easily cost you millions. And hey, sorry, who has that kind of money to lose?
Exactly, Alex. So, in today's episode, we are breaking down seven costly mistakes that are specifically tailored to South Africa and that are South Africans facing due to low incomes, family pressures, and a lack of financial education. We'll share practical tips to protect your wealth from these mistakes and to build a secure future.
Well, then, let's get going. In our last month podcast, we spoke about savings, and saving and investing kind of go hand in hand. You need money that you've saved up to invest. So let's quickly remind you what we said in last month's podcast, why it can feel so difficult to save and then obviously also invest in South Africa. What are the main challenges that we're facing here?
So, investing in South Africa isn't easy. With 50% of the households earning an income of 3,500 to 15,000 Rand, it's a very low threshold. Then we have a very high unemployment, 33.5% of the entire population. That's a big chunk. And then, of course, that results in many women not feeling comfortable enough or feeling like they have the opportunity that they can afford investing. On top of that, like the cherry on top of that is, of course, that we have a high inflation rate. Of course, there is no wonder that people are, hesitant to invest into their future.
Absolutely. And let's not forget about the expectations that many people face, especially younger people that manage to earn reasonably well to assist family, especially also extended family financially. And that can often be at the expense of their own financial security because it eats into their own savings. Plus, there's often also the social pressure, to keep up with the Joneses or to show that you are successful. So often people rather spend money and also, reward themselves for having earned a lot of money rather than saving that money away and then investing it. And one of the other biggest issues I feel is financial literacy. That is one of those points where a lot of people just struggle. It's not something being taught in school. So you always have to put in your own effort to educate yourself. And a lot of people just feel like it's so overwhelming. So many don't really know what they're doing when it comes to finances.
Exactly. So combine that with mistrust into the financial institution due to, scandals. It can easily feel really daunting to invest in general. But here's the good news. There is an easy way to avoid seven financial mistakes so that you are on the right path to financial independence, no matter your starting point.
Right. So let's get started. What are those seven mysterious mistakes? And most importantly, how do we fix them? Anna, what's the first one?
The first point is actually an easy one, not having a clear goal. Many people jump into ETFs or stocks without actually having a clear strategy. It's understandable, like you're feeling FOMO, you're feeling like the fear of missing out, you're actually wanting to start on that journey, and then you jump the gun. You just start, you buy your first stock, you buy your first Bitcoin, so without a plan, you're strictly speaking just gambling. So it's very important to actually first have a plan before you start investing. That's the point that I'd like to make when we are coming to clear goals and having a clear strategy. And then on top of that, 40% of women don't have a retirement plan, indicating low confidence in their own financial knowledge. And that is a statistic that came from FinScope in South Africa, 2023. It's very important to start right, to start your journey right. But start it correctly. So how do you fix that? You set a specific goal. Let's play that through on the example of the tax-free savings account. Now, the tax-free savings account has an upper cap of a lifetime investment value of 500,000. So let's say you want to save 500,000 into this account. Yearly, you can put aside 36,000. So, you have to figure out a way of actually putting that money per year into the account until you hit the 500,000 that you put into. And that could be a starting goal. You could actually set that as your initial goal. Use the tax-free savings account, try to hit the 500,000 goal for your lifetime value, and then use the tax-free savings account as a retirement tool, because that's what it's meant to be. The reason why we are not taking money out is the moment you actually de-investing from a tax-free savings account, you can't put that money back in.
Well, I wish I had known about the TFSA when I started out. I only got my TFSA a while ago, but quite in the beginning, I also did my, financial education, made sure I knew what I was doing. And one of the things I had to learn was, okay, how much do I actually need for retirement? And I had to work out how much that was and calculate it down to monthly savings. And let me tell you, it was a shock. It was way more than I could possibly imagine even to save. But I was determined, I'm going to get there. And so I set myself a monthly target that was doable for me. And then with time, obviously, I started earning more money and I was able to put more money aside and so on. So I kept increasing the monthly savings amount until I actually hit the target that I needed. Yeah, it comes down to having a clear savings goal, because that helps you so much to stay focused and not go like, oh, well, like this month I would rather do this and that than save that money, because, you only live once. But if you do that too often, then you completely detract from your savings goal. So having a number in mind is super, super helpful. It's like your guiding star.
No, I love how you said that. That's very correct. The TFSA, as an example, I actually knew about that way earlier than I thought, but I didn't use it correctly. I actually de-invested. Can you believe it? It wasn't that much money, yeah, but I have done it. It's okay. I think we all can acknowledge when we make mistakes about investing if you don't know what happens in the end with it. And it wasn't that much, so it's okay. But just generally, what you said about having that number of retirement in your mind, knowing what you actually have to reach, like, I'm sorry, the way you said that this was a shock for you, yeah. Same for me. It's actually fascinating how much you have to change as a person in order to hit that goal. That is, I think, on my journey, the one where I was like, oh my God, I can't believe how much I have changed as a person to reach the number that I needed to reach. I never thought it would be possible. And now I'm over it. I'm over it. Sorry, it gets me very excited because I never thought it would be possible. I never thought I would be able to actually hit that number. And now, with that in mind, you change, you actually make sure that you have to become a different person in order to actually reach that goal. But yes, I couldn't have said it better, to actually calculate initially where you have to be at in order to reach your goal is one of the very first steps that you need to take in order to reach a goal.
Another very common mistake people make is the lack of diversification. Now, what does that even mean? Diversification means that you invest in many different pots. The saying, like, don't have all your eggs in one basket? That's exactly what that means. What a lot of people do is like they have one or two ETFs and they think they've invested in the entire world. But if they look closely what that ETF invests in, then they might realize, oops, the majority of the companies sit in the USA, or the majority of the companies are tech companies or something like that. So even though you have maybe even 3, 4 different ETFs. It's very important to actually look what do they invest in and how much do they overlap. So it may seem like you are diversifying, but in fact, you're not. So let me give you a little tip what you should be looking out for. You should be investing in the global markets, like the industrial countries. Then you should also invest in the developing markets, also a very important market. Real estate, using REITs. And then we have commodities, because what happens quite often is if you invest in companies and they are not doing well, commodities often rise. So it's a nice way to balance out your portfolio. These are just examples, but what is the most important point here is to take a very good look at your ETFs and make sure they don't overlap too much and actually do cover the majority of the world.
Yeah, so like you and I learned about investing before we actually started with it. Yes, there have been mistakes that brought us to that journey, but we basically created first a plan where we needed to go. We calculated how much that costs, We then started slowly building into the right direction. And then with that plan, we started investing and had the diversification basically pinpoint. But like I think for a lot of our listeners, it's going to be difficult to understand what that means. Let me try to give it a bit more tangible example. So a lot of people think like, oh, okay, I'm going to invest in the S&P 500. Yeah, it's a great ETF to invest into. It's a great index to follow, but it's diversification wise, it's still on the lower range. I mean, as it says, S&P 500 is diversification of 500 companies. So companies is pretty decent. I wouldn't say that's too little, but it is solely in the US market. So there you go. There's where the diversification is a bit limited. If something goes wrong in the US, then your investment could really suffer from that. That's why it's always best to actually diversify, like you already said, countries, emerging markets, established markets like the US, like Europe. But like there is people that say like, okay, cool, I want to invest into the Nasdaq, for example. That's a lot of technology. And then I think what a lot of people don't understand is that those ETFs that you then buy, they overlap. Let's say you buy from the MSCI World and then get an investment from the S&P 500 and then do still a little bit of the Nasdaq. You don't realize how many of these companies that are already in there overlapping. And that could really create a risk to your portfolio because you now out of a sudden have a different risk diversification in your portfolio, something that you haven't calculated into the equation. And then there is a situation like the one with Trump, coming in and out of a sudden your portfolio is in the red much more than you're comfortable with. That can be very, very daunting. We don't say don't do that, just be aware of when you're doing it, that you're actually doing it because you wanted to and not because it surprises you.
Absolutely. When I started out, I was still living in Germany, and there's this one website called justetf.com. It exists in German and in English. It's a very good website that gives you all the ETFs that are available on the German market, and you can filter it in whichever way you want. However, it is overwhelming. There are so many different options, and many of these ETFs are like very similar. And you don't know, like, should I take this one? Should I take that one? I mean, putting my life savings into this, and you could easily panic, And that is why it's so important to first learn what matters and what doesn't matter. Is the size of a ETF important? What about the costs? What is a low cost? What is a high cost? And so on and so forth. So before starting and just buying, and like we said, possibly buying ETFs that don't diversify enough, even though they look like it, it's important to really understand what goes into an ETF and to understand what criteria about selecting an ETF matter and which ones don't.
Yes. Market timing is a trap, as one of the next mistakes. A lot of people think that market timing is great. And if you were to be able to foresee the future, it would be. But none of us really can. Studies show that consistent investing really beats market timing by 80%. That's an Investec study in 2025, so fairly recent. And just generally, if you buy the average, basically invest, no matter if the market is higher or lower, which you don't know anyway, unless you look into the past, then you buy the average. every single time. And that basically balances itself out. So if you decide to start investing, let's say we stick with this example of the TFSA, and you consistently do 500 Rand per month, you buy the average of the market development. Every month could be high, could be low, but in general, it will smooth out over time because, of course, it will go up over time.
You're absolutely right. I mean, if you look at the performance graph of any ETF, it will go up and down, and it very much depends on the window you're looking at. If you look at one day, it's chaotic. If you look at 1 week, 1 month, half a year, 5 years, it goes up and down. I mean, we do have crashes, they happen, and we can't really prevent them. But if you look at the entire graph for the entire existence of that ETF, the price of the share will go up. Yes, it'll dip again, but then it goes up. And every dip is usually not as low as the previous one. So yes, it just goes up. And those little ups and downs on a daily basis, even a weekly basis, they call just random walk of the share price. There are different factors that influence the share price, and there's nothing we can do when it comes to those factors. So yeah, it's best to buy, hold, forget.
Yes, it's like you said, Alex. The random walk of the share price is a very limited picture in time. But if you look at it in 5, 10, 15 years, the share price will always go up. Investing is definitely something for future you. It's something that you do in order to make sure that you are well off in the future.
Another huge mistake, and I dare say one of the main reasons why people fail at the stock market, is making emotional decisions about selling or buying. And fear and greed are the two biggest wealth killers. When the stock market drops, whether that is an actual crisis or just a bad day, doesn't really matter. Panic can set in and you fear, oh my gosh, I might lose it all. And then you just sell. And then on the other hand, when there's a hype about a certain company or Bitcoin, for example, then the price obviously goes up because everyone wants a piece of that cake. And you also want a piece of the cake and you buy at a higher price. And then basically what you did is you bought expensive and you sold cheap. You can see how that leads to loss, right? Now, the best way to fix it is what I said earlier, buy, hold, forget. It's important to create a solid financial plan that is based on your personal circumstances. And that includes taking into account what your goals are, how much they cost, like how much do you need to save on a monthly basis, what return do you need to achieve. It also includes your willingness to take risk and your need to take risk. The more risk you take, the higher the return, but also the higher the possibility to lose it all. Though, to be fair, the chances of losing it all are extremely low. But there's the risk that you can and will lose money. So the risk is real. And that's why it's important to, decide on what is your risk willingness and based on that, create your own plan. Then automate your investments. Like every month, have a certain amount deducted from your account, go straight into your savings. You don't even need to think about it. And that also stops impulse moves, such as selling and buying. You buy and you hold. Hold until you have retired.
Well said there. I have a couple of examples actually there that I'd like to speak about. Like a friend of ours was really getting into the Bitcoin hype. She was like, oh my God, I'm missing out. So I bought the Bitcoin and then it dropped. And it was a substantial amount of money. So she got scared. She sold it. And then now it's up. It's very well up. But that is why we always say that if you are dealing with financial instruments that you don't understand, you shouldn't invest into it. The biggest risk to your portfolio is always going to be you. So it's best to actually step away from your portfolio if you are in an emotional state, especially if the numbers are red, because if you don't sell, you actually don't lose. Well, I mean, you still could lose, especially if we're talking stocks, as that's an individual share. And if the company goes bust, then this is what's happening. But if you're investing in ETFs, that's usually not what's going to happen. And my other friend, she bought in at the beginning of the year. So like the prices were up. And then the whole tariff situation happened. And of course, the price just dropped. And she called me in a panic and she's like, this is what's happening. And I'm like, this is great. I'm buying more. This is sale price right now, so I'm getting more. And then she's like, okay, you're kind of calm with that. I'm like, yes, because we are not looking at a specific amount of time here. We're not, this is just a little bit of a small fragment of time that we're looking at. It will even or balance itself out if you're patient enough. So please be patient and wait and maybe invest a bit more. But like you said already, that's why it's important to look at your risk profile and so on.
Absolutely. And if you really struggle with your emotion, if you experience fear or greed, both are the dangerous emotions when it comes to investing, do get help. I'm not talking about a psychologist here, I'm talking about a financial advisor. And when it comes to financial advisors, it's important to know that there are two types. We have fee-based financial advisors and commission-based financial advisors. The later one is the most common structure in South Africa, which means they often sell you products from which they get higher commissions. And you don't pay anything upfront, which is great, but obviously these people also need to eat. So they get paid through commissions. Every time you pay your premium, they get a small percentage of that. And not saying that they are better or worse advisors than fee-based ones, but let's say there's a risk that their interest might be conflicted. Whereas with a fee-based advisor, you're paying that person up front. Might not always be cheap. However, you do know that they have your best interests at heart. And if they're fiduciary, they even have their statutory requirement to act in your best interest. And they will then offer you the product that really suits your situation best. Or they explain things, they take the time to explain all the details to you. Because, I mean, you're paying them for the hour. So whether they're selling your product or if they're giving you financial advice makes no difference to them. So when your emotions are really getting too much out of hand and you panic, please don't sell. Go find a fee-based financial advisor, talk to them first, and only then, hopefully, you've calmed down and make decisions.
The next one is to ignore fees and taxes. So high fees can really eat into your returns. So some South African investment platforms, they can charge 1 up to 2%. And then the scenarios that you just mentioned, the financial advisor fees come on top of that. So it could easily cost you 200,000 over 20 years on a 500,000 portfolio. That's money that I'd like to keep. I don't want to give that to someone else. I want to have that money in my portfolio and not pay to someone else. And then, of course, don't forget taxes. This can easily hit your investment if it's not a tax-free savings account. So the solution is to obviously choose low-cost ETFs, and you can maximize the interests from tax-free savings and from retirement annuity for tax breaks. So let's give that an example. From your income, you can invest 27.5% into your annuity. And that income, because obviously you are being charged on it during the tax year, you will receive that as a tax return. So the way how I use it is to actually, instead of taking my tax return and then buying a nice holiday, I use that to fund my tax-free savings account because, well, it's easier to get to the 36,000 per year.
Let me quickly jump in here. We've mentioned ETFs quite a bit, and you might have heard passive or active funds. Now, an ETF is a so-called passive fund, and they are low cost for that reason because there is no one actively managing that fund. It just follows the index of a stock market. While the active fund, like a union trust, for example, there is a manager that always tries to beat that index. And beating the market is possible, yes, but it is a rare occasion. And unless someone can do that repeatedly year after year, and so far no one has, then it's just, luck that the 1 year they beat the market. So active funds usually have higher costs because they have someone trying to beat the market. Sometimes they do, often they don't. And in the end, they are the same or less than passive funds. So when it comes to choosing the right kind of fund you want to invest in, ETFs or passive funds have the benefit of low cost. Sometimes active funds have higher returns. To look very closely at the different funds, see what they have returned, what they cost, and so on and so forth. And just a quick little thing here. performances in the past are no indication for performances in the future, just for you to think about. And then, of course, we spoke about taxes. There are 3 different types of taxes that you need to look out for when it comes to investing. There will be capital gains tax, there will be dividend withholding tax, and there would be interest tax. Now, depending on how you invest, luckily, if you in South Africa, if you earn interest on your South African savings account, if you earn dividends from your South African shares, then you actually are exempt for up to 23,800 Rand per year for individuals under 65 years, which is actually quite a big amount, which is lovely to have. If you invest in foreign stock, then that exemption does not apply. So it's very important to know what you're investing in and what taxes do affect you and which ones don't.
Specifically for fees and taxes, it's actually quite nice to use AI sometimes. I have been doing this, that you do your calculations and you just like, here's my fund fact sheet and this is the funds that I'm interested in. Could you check on taxes? You check on the fees and as a return on investment. So it's been quite beautiful, but like you said, past indication is no indication of what the future will bring, especially if you have a lower time frame for an investment portfolio. I mean, I've looked at retirement ones, very interesting. It looks, it can go up as 22% that you earn. I'd be very keen on earning that. But if you can't perform this continuously, then it's like you said earlier, it's luck and it can go quite low again and you still have to pay the costs on that.
Now, mistake number 6 is something I already mentioned, and that is relying on only commission-based advisors. Like I said, that is the most common fee structure in South Africa, and it's great because, you don't have any upfront costs. However, they just might, not saying they will, just saying might, there's the risk that they will, push products on you that just have higher fees. That means that they will earn more commission. And especially women who, juggle family and work, mental load is a thing, definitely. So it's just very easy to give that responsibility of making the right financial decisions to someone else. And if you don't have to pay that person, even better. So it's easy to, just hand off that responsibility, but you do run the risk that that person might not necessarily have your best interest at heart. So fee-based advisors are someone who charge per hour. It's usually 1,000 Rand and upwards per hour. So it's not cheap, but they then work for you, not for the companies whose product they're selling you. So it's always best when you meet someone for the first time, or even before you get to meet them, ask like, okay, listen, how do you get paid? And if they say like, yeah, you don't have to pay anything upfront, red flag. Also, a very important thing, but that goes for fee-based or commission-based advisors, they have to have an FSP number, financial service provider number, which means they are registered, which means they have studied a certain field of finances. And if someone has a fiduciary duty, even better. So always ask first, how do they get paid? Now, I have this little story about the financial advisor that I trusted at the beginning of my financial journey. And he happened to have the same last name as I do. They were still back in Germany. And it's not an uncommon name, but it's still nice, to meet someone with the same last name. And he could talk. That man could sweet talk you. And he sold both my mom and myself a certain type of life insurance that you would pay into month after month. And then at the end, you would get out a certain amount depending on how the market fluctuated. And he knew how to evade giving direct answers. And back then, I was just too naive to even realize that. And I got that insurance. And then at first he explained to us the first 2 years fees will be quite high, so you won't make any profit, but then later it becomes more and more. And I'm like, okay, cool. First 2 years down the line, sorted. But then I realized they still kept deducting fees. I think I paid 100 euros each month. That's about 2,000 Rand. And then they would charge, I think it was 8 or 9 euros every single month in fees. He didn't mention that right in the beginning. He just said like, all your fees will be covered in the first 2 years. And then I still had ongoing fees and so on. Yeah, I think it was like 6, 7 years in when I actually started to educate myself about finances. And I looked at the insurance I had and I was like, oh my gosh, just look how much money is in there and how much money I've actually paid in. And the money I've paid in was more than was in there. And then after 8 years. So I've made a loss. And I was like, not happening. So I sold it at a loss. It was money I had to pay for learning my lessons, and then reinvested that money into ETFs, into my own portfolio. And hey, guess what? After the first year, I started making profit. So, not saying financial advisors don't want to help you, they do, but some people do have their own interests at heart as well. So, just always be cautious when going to a financial advisor.
Yeah, I couldn't agree more with you there, Alex. The other big mistake is not to start now. That's one of the biggest mistakes a lot of people do. With South Africa's high inflation, it's currently at 5.2%, which is really high. Every year you delay, you actually have a loss of purchasing value in your money. Thousands rand monthly that you actually invest, and we're going here at a very low investment return of 8%, could easily grow to 1.7 million in 30 years. But if you wait 10 years, then you will even easily have to double the amount to catch up on that return of investments that you want to achieve. So you need to start small. It could be even 100 rand per month if you don't have more than just start with this in a high yield savings account for you. Let's say you want to just create a bit of a safety fund, or you put this money into an ETF over time. With compound interest, this will become more and more and more. And that is basically your best friend. Compound interest is your absolute best friend when it comes to investment. So time, patience, and continuously putting money aside for yourself, even if it's a low amount, is what is best for you, especially if you're young. Yeah, my story is a very simple one. I've started very, very late. Well, it felt very late. Well, it was late. It's real there. Because I felt like I don't have the money to invest, which is, of course, a story that is made up. Everyone has money that they can invest. You just need to live within your means. And for me, that resulted in a very rude awakening. And now I am saving 50%, actually over 50% of my income, just because what I've done is that I've never paid out any of my increases for quite a long time. And that resulted in me now living on a comfortable way of how I live. It's not uncomfortable, but the rest of the money is being invested. Yes, it's a very drastic approach. I'm aware of that, but it doesn't hurt me because I've actually never spent the money. So if you don't spend it, it doesn't feel like you actually have it. And I'm very good at pretending like I don't have received that money. And that is my best friend now. So I'm investing now as much as I can. Of course, compound interest is very much helping there. But if I would have done this much, much sooner, I wouldn't have to live like that.
Now, if you look at South Africa's challenges, high inflation, unemployment, family pressures, and so on, it can make investing feel like a luxury. But women actually live longer than men. I mean, I think we all know that. In South Africa, the average age of death for women is 68, which, let's be honest, is not great. However, all the leading causes in death are illnesses that can be managed through lifestyle, like all your diabetes, your heart diseases, HIV is another one, tuberculosis. So all of these can be managed through lifestyle. And a lot of us actually do live longer than that. Yet only 6% of women can retire comfortably, according to a study Sanlam did in 23. So the earlier you start, the more you can benefit from compound interest. So it is absolutely critical to start today. And if you have children, let them start the moment they earn money.
You actually can start for them. You can use their pocket money and invest it in a tax-free savings account, which could give them a real beautiful edge at some point in time. But yes, I couldn't have said it better. Let's look at like easy tools like, the JSE All Share Index. If you are investing in South Africa, like that has averaged 10% annual returns over the past 20 years, despite volatility. That's from a statistic of the JSE in 2024. And then with tools like your tax-free savings account and low-cost platforms like Easy Equity, there's just never been a better time to invest and to start. And then, of course, you have all this knowledge out there that you actually can receive from online, from podcasts like ours that make it much, much more easy to start, to feel more comfortable in investing?
Well, we keep going on and on about compound interest and how it is your best friend. Just a quick little explanation. Compound interest simply means that you are getting paid interest on the interest that you have already received. And just how powerful time is, I think, best demonstrated using an example. So let's say for 30 years, you invest 1,000 rand, which means you will have in total invested 360,000 over the entire time, and with a very meager 5% return per year. You will have 837,000 Rand after 30 years. Yay! And 1,000 Rand isn't much. Now, if you only have 20 years left, let's say you double that amount, so you save 2,000, you will have invested a total of 480,000, and after those 20 years, you get 825,000 Rand out of it. Now, this is almost as much as if you had saved for 30 years. However, you had to double that amount and still get less. And now the big one here is if you only have 10 years left. And now you triple the amount. You save 3,000, which means you again have invested 360,000 Rand over that 10 years. But in the end, you only get 465,000 Rand out of it. That is about half of what you would have gotten if you had started 30 years ago. So time is of utmost importance. The longer, the better. And the longer you save, the less you can start off with. And then, over time, you can always increase that amount.
I believe you used a very low investment return here. It's 5%. That is very conservative. Most investments that you invest into are much higher than 5%. Of course, it's nice to show that example, because if you have more money that you receive, you still have to take inflation into account. So basically what Alex did is show you a cleaned up interest rate. But yeah, let's wrap up. And actually, before we wrap up, we want to do the key takeaways for you one more time. So the first one is, of course, to set clear goals. Tie your investments to your personal dreams, like a retirement, like early retirement, like making sure that your kids have an educational fund, like something that matters to you, because a clear goal, something that really excites you, something that really sets you on fire, is the best way to keep you going with savings.
The next one is to diversify and to make sure that you spread the risk across different asset classes, countries, industries, sectors, and so on. Just make sure you really diversify, meaning look very closely at what the ETFs you're investing in actually copy. And then obviously it also helps if you just automate your savings. Use debit orders to stay consistent. Every month a certain amount, and whenever you can, increase that amount.
And minimize fees. 1 to 2% can cost you in the long run. So make sure to educate yourself enough so that your money is actually giving you a return on your investment. And minimizing fees is another lever to make sure that this is happening. And seek unbiased advice. Rather pay your financial advisor upfront so that they have your best interest at heart, so that they can give you a proper advice on your personal situation.
And most importantly, I cannot stress it enough. Start now. Like even if it's 50, 100 Rand a month, it's not much, but it will make a difference, especially if you're young. So start now. And most importantly, stay calm. Don't let, emotions derail you from your plan. Have a plan with your clear goals and then just stick to it. Buy and hold.
Before we completely wrap up, we want to tell you the story about Anne Schreiber so that you actually understand a little bit that it's never too late. I think that's something that a lot of people think it's too late. Anne Schreiber was a retired auditor, and she became a millionaire through investing in stocks. Her investment strategy was quite straightforward, but very, very effective. She started investing only at the age of 51 after retiring from her job with an initial portfolio of 21,000 US dollars. That is an equivalent of 297,000 US dollars if we would put that into terms of today. And by the time she passed away in 1995, at around 101 years, quite an achievement in its own, her portfolio amounted to 22 million US dollars. That is about $36 million today, dollars, yeah? That is incredible. She managed to achieve an annual rate of return of 14.6%. That's quite high, which significantly outperforms the S&P 500 during the same period. That was actually insane. Do you want to talk a little bit about the strategy that it was included, Alex?
Well, first of all, she invested in diversified baskets of high quality stocks and then reinvested the dividends to benefit from compound interest. So whatever was paid out, she then immediately reinvested instead of using it. And she hardly ever sold her assets, which obviously allowed her investments to grow over time. And she never attended any shareholder meetings or read any financial statements. And that indicates that she actually didn't micromanage her investments, meaning buy and hold.
Additionally, she was living very well within her means. That allowed her to increase her savings and basically used 80% of her income too. Like, you don't have to live like this, especially at that age, but it does show very well that you are able to invest at the age of 51 and still become a millionaire if you want to. And that's what we wanted to bring across, that it's very important that you don't think it's too late. You still can deal with it. I mean, like, at the end, that is still 50 years that she invested. We have to be quite clear about that. That is a long time.
And remember the Chinese proverb? The best time to plant a tree was 20 years ago. The second best time is now. So it's never too late to start investing. And whether you're in your 20s, 30s, 40s, or even older, every rand that you start investing today is a step towards a more secure financial future. So it's very important that you make that first step. Doesn't matter how small it is. Start with setting up a TSFA. Start with 100 rand a month and just watch your money grow.
So if you enjoyed this episode, we would really like you to give it a like. It helps to spread the news, and we would appreciate that very much because we're wanting to make sure that a lot of people are able to actually receive the information that they can start investing, that they can deal with their money, that it's not too difficult.
And never forget, you are a money magnet.